it with a lot of the technical indicators that we use.
When you say distribution, do you mean breadth in that a broad amount of stocks are participating in the rally?
Well, we're starting to see the momentum shift a little bit, where we're seeing some. I mean, just very simply, the percentage of stocks within ETFs or markets above the 10-day moving average, above the 20-day moving average, those are starting to turn red. That might be just a function of those moving averages flattening, but sometimes when they flatten, they go down as well. And a lot of things in the Nasdaq have already started to roll over. The 50-day moving averages started to roll over. 20 days cross the 50-day. Um, I think that it's some of it could be headed into the end of the quarter, position squaring. Today was pretty extraordinary because we're watching a list of about 12 stocks that were just getting liquidated. And when I say liquidated, Viacom was just cut in half in 2 days. And, just Discovery and some of the Chinese names. Now, I have some speculation of who it might be. There could be a big fund. I've heard a Tiger Cub fund, perhaps. No guarantees or, you know, confirmations that I know any of the players in this, but it could be SoftBank. They've had some liquidity issues, and they also, the thing that kind of makes me think it's SoftBank is if you look at the tech stocks from last summer, and they were just on this parabolic move up, and every sell signal that I got failed immediately, and then they just sort of gave up and stopped. And that's sort of the same pattern if you look at Viacom and Discovery and a few of these others that are mentioned as those liquidated. Those look kind of like the same trader was buying them, and that's kind of my speculation that it could be SoftBank. I mean, we may never know. We may know, but SoftBank also, it was confirmed that they are under SEC investigation for their trading last year in the gamma squeeze. So I don't know who it is, but we'll see. We'll see in the coming weeks who sold 33 million shares of Discovery. And the thing that's crazy about this, it's not just like a top 10 holder. Some of these funds that have been mentioned aren't even in the top 10, and maybe some of it is traded on swap through a large broker like Nomura or Morgan Stanley. So they're kind of hidden who owns them, but whoever was selling them, that's like the number one or two largest holder of the stock. And that to me says that they jammed these things up and they just got forced liquidation here today. It was pretty amazing.
Yeah, just for the context of everyone watching, there was a pretty significant market event today. Tom, you and I were actually on the phone preparing for this earlier this morning, and you just got a Bloomberg alert or something. You said, "Wow, there's this huge market event. People, a big fund liquidated a large percent or perhaps their entire position in Viacom, Discovery, Shopify, Baidu, and those stocks expectedly had a rough day." Tom, what does it mean to you when a fund has a forced liquidation? What's the significance of it? And what are the mechanics? If you were a fund manager and you had to, you were forced to sell, why would you be forced to sell?
Well, I actually know about a forced liquidation personally, but that actually was over a month. But something happened here. Something snapped, and maybe this fund had the wrong trade with the recent bond market collapse. I don't know. They may have had some European entity go bankrupt, and they were in the hole $400 million. There's a lot of people out there that use leverage, and a lot of funds use leverage, and I'm rarely seeing forced liquidations when leverage isn't involved. So I am assuming whoever it was levered to the gills, and they got a tap and said, "We've got to just exit." And they called up Goldman Sachs today and said, "Hi, would you mind doing a trade for me? 12 of them." And it's probably about 200 million shares. So that is probably it. And they might, having it be one day, or it might have started the last couple days because some of those stocks had already started to move down. It just got to the point like get out by February, or excuse me, Friday at at the close. So that's what happened today, and it became very evident that these stocks were under fire. Now, I actually I I bought some of those stocks. I bought Discovery and Viacom market on close orders, just to play the cleanup trade, because if this large seller is gone, we could see a relief rally in these names over the next week. So I'm happy to do that. I've done a lot of those over the years.
Yeah, buying the dip. It's not just a slogan. You exerted that trade, and I'm interested to see how that played out. Tom, it's important for the people to know. Everyone is familiar with the phrase "a short squeeze" because of GameStop, when you're forced to buy back when you use leverage when you short something. But as you mentioned to me on the phone today, there's also something called a long squeeze, when you buy on margin and you have forced to liquidate. And it sounds like that's exactly what happened today.
Well, it's also, there's another dynamic to it. So a short squeeze is a very heavily shorted stock, um, and when there's good news or the stock starts moving up, like GameStop, uh, the shorts have to cover, and it just creates another source of buying. Now, on a long squeeze, which we've seen, I think we saw one of the biggest long squeezes ever back last March. It was because nobody was really short airlines. Nobody was really short uh, the cruise lines and the retailers. The short interest on those were actually very low until they got to the very bottom, and then shorts started shorting them at the wrong time. But if you don't have that natural buyer as a short cover, you're going to have a deeper pullback on things, and that's exactly what I like to look for in a stock where the shorts have just given up, or they just don't have the confidence to short them. And a lot of them last year were value stocks, and people just had given up on trying to short those. And now um, I mean, I think there's some long squeezes out there. I mean, nobody was really short Viacom or Discovery. It's not a heavily shorted name. Maybe they were a little bit in the last week, but um, it's a value stock.
Tom, a few minutes ago, you mentioned the FANG stocks, the big tech, the mega cap stocks, and how they were surging early on in the pandemic. But over the past 6 months or so, they've pretty much been trapped in a range, and some of them even down. So they sort of passed the baton onto the small cap stocks, as well as the uber growth stocks, as well as SPACs. But now all of those trades are sort of fading. And I think even over the past, let's say, 20 days or so, I think the Russell 2000, small cap stocks, is actually down, or not up. Where do you see this going forward, Tom, in terms of sector rotation? Because I know you've been on Real Vision earlier this year talking about inflationary fears that could be could rattle high growth stocks like Tesla, like DocuSign, and you've been proved largely right. You were interested in reopening stocks like energy, but I understand now that you've gone out of energy. So tell me about, where's the baton in terms of leadership? Where's the baton going to be passed to next in terms of sector rotation?
Okay, there's a lot to unpack there. So I've thought that the parabolic move in tech, these mega cap stocks, could just cool off, and they haven't really done much. They're fun to trade in little ranges, but they haven't really done much. And even when they reported earnings, they really didn't get the bang, on the upside. And a lot of semis as well. And I was speaking to an technology portfolio manager in Asia the other day, and he's like, I just can't believe that Nvidia just had such a great number that the stock went down. And I'm like, well, it's crowded. So I wouldn't be shocked to see tech take a breather. And we have earnings coming up, and I think the comps are going to be in the next couple quarters tough for them because they really did well with the stay-at-home trade. So we'll see what happens there. But as far as with Russell, the Russell really it's littered with a lot of, value names and regional banks, and tons of energy and materials and retailers and stuff that a lot of stuff that they don't make a lot of money, or they're actually zombies. But still, I liked energy back in September and October, and I got mega long, and I was on Real Vision with Ash and saying, yeah, I love it because I think Joe Biden's going to be president, and I think he's going to be the best thing that could ever happen for energy. And everybody was like, wait, what? But everybody thought that with Trump, and then Trump said, let's drill, 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 and what happened is you had too much supply. And now I think Biden's putting some clamps on the drilling activities, and I think that the supply demand picture will work out well for the bull. So I did sell all my energy stocks recently. I'm fortuitous. I sold it like right before the day before the peak, and the next day I thought, oh crap, I think I sold too early. But I just want to buy. I'm looking for places to buy them back. I think there's still a lot of juice there. They're a terrific reopening play, an inflation play, and I also like financials. And I'm also hoping that we'll get a pullback. We haven't had a pullback enough, so I'm basically on the sidelines with those. I did buy consumer staples today, and as far as a rotation trade, consumer staples always seem to gravitate towards the top of my list when markets get a little dicey, or I see some liquidation or distribution, because I think they're very dependable. They're very dependable earning type stocks. Procter and Gamble, Walmart, Coke, Pepsi, a few others I bought today, and I bought the XLP Consumer Staples ETF. I think those are just pretty much hiding places. They've had a little bit of a run so far, and I think there's still a little bit more they can do. So I'm not looking for them to, be this giant outperformer, but I'm looking for places to park money and get a decent return.
The fact that you, as you say, you're looking to hide your money, park your money, that sounds like there's perhaps something dangerous out there in the market. If you were very constructive on the whole market, I'm going to guess you probably wouldn't have to hide. Tell me about that. Why do you have to hide?
I tend to get accused of being too bearish, but I tend to pick my spots, and I buy when things are oversold and market sentiment gets to levels that are overdone. And back in March, I was on Real Vision and a couple other shows, and I was telling people I'm buying like crazy. I covered all my shorts, and people looked at me like I was just nuts. Unfortunately, and I'll admit, I had some great gains, and I took gains too soon, and I just want to I don't want to talk about it, but we all do that. It's you do what you can at the exact moment with the data that you have. So yeah, in hindsight, I didn't think the S&P would be near 4,000. I didn't really think it would be at 3,000. I'm not really good with pandemics and trading pandemics, but because now we know, buy every pandemic. But so right now, yes, I'm hiding in consumer staples. I have a little gold exposure. I'm not a gold bull or bear. I think I'm there. A little silver exposure, slightly positive in those right now. I think the dollar can continue higher, which I was telling Ash last time. I thought the dollar was going higher. He looked at me like, we got to end this call. But I don't have any Bitcoin. I don't have any Bitcoin exposure. It's just not something I trade. I do look at it. On Hedge Fund Telemetry, I give opinions of which, buy and sell places. And back when it was at 3,000, I had DeMARK buy signal, and I told people, and they were like, what? Nobody really cared. And, now here it is, 50,000. It's pretty amazing.
It's something to behold, Tom. You've mentioned that there's sort of two battlegrounds in the market. One is with regards to the size of stocks, so mega cap stocks versus small cap stocks. I think we've covered that already. But another lens through which you look at the market, another battleground is reopening stocks versus stay-at-home stocks. Tell me, how are you seeing that battle evolve?
Okay. The stay-at-home stocks, we all know the Zooms, the tech companies, Netflix, Roku, we watched all those do exceptionally well, and even the reopening stocks are. You have energy, you have retail, you have cruise lines, you have airlines, financials are in there as well. And I'm looking at my Goldman Sachs thing here. Hold on. So the Goldman Sachs basket of stay-at-home was up 1.3% today, and reopening was a little better at 1.7%. So those, everything went up today, it seems, but those have been, teeter-tottering around of what's working, and I think that the it's almost too obvious that there's going to be a reopening, and it's the problem I have is a lot of these stocks have already moved so much that they're pricing in just an unbelievable recovery. And I look at Disney. Disney's a great company. I love Disney. Been long. I've been short. I'm short currently, but the movie theaters aren't going to really have full capacity for quite a while. I'm looking forward to going to movies, by the way. And then Disneyland and Disney World and all the theme parks. I think Disneyland, they were talking 15% capacity, and then maybe 25%. And this is like towards the end of April. It's a perfect time to go if you can get tickets. Going with 25% capacity would be just amazing, a great experience. But it's going to cost a lot for them to reopen and run those parks again. I mean, they haven't really had the capex to pay all the people and to run the parks. And I think that those, like, Disney's ahead of itself, and it's clearly, I think, 30% higher than its peak back in January of 2020. So I think, if anything, there's a lot of stocks out there that are just priced it in right now. And the airlines, cruise lines, perhaps. I mean, TripAdvisor is up, I think, 50% higher than where it was in January of 2020. Yeah, everybody's going to want to travel. I'm taking I have 3 trips planned. So, we'll see how far those go. But I think there's a little bit of there's still a little bit of a trade there. If those back off, I'll buy them.
Mm-hmm. Tom, you mentioned that you have 3 trips planned. By any chance, are any of them to Miami, where I understand that things are heating up a lot?
I'm not going to Miami. Everybody, I live in Greenwich, Connecticut, and I have a lot of people and friends in New York that, I'm in Palm Beach and I'm moving to Miami, and, they're just giving up. I'm going to Dallas to visit my daughter at SMU, in Los Angeles to see some friends and clients. And then what's my next one? Oh, Charleston to see another daughter. So they're just subtle little trips, but not Miami. And boy, what a mess was spring break last week. And that was really something else to see those videos.
Yeah, it really was, and it makes me think. Some in the market are just foaming at the mouth, bullish for reopening stocks, like Disney, like airlines, and others are more cautious. It sounds like you're more in that second camp. But tell me, on the topic of Disney, that just makes me think that it kind of is neither fish nor fowl, because now it's a reopening stock because it has Disneyland and the like. But during the pandemic, investors who were bulls could say, oh, actually, it's a stay-at-home stock because of Disney Plus. How are you thinking about those stocks that don't really fit in either category? And it can't be sort of put in those boxes, like it's easy to put a cruise line or another stock.
Well, one thing about Disney, and I used to be a media trader as well way back when, in my hedge fund. The stock's not cheap right here. There's times where Disney's really a good value, and then there's times where it's very expensive. So it's expensive right now. Disney Plus, their subscriber numbers were great. I actually got Disney Plus because I'm on Verizon Fios, and they gave it to me for free, so I count as a subscriber. I think it was a big ramp up. We'll see how well it does. I'm sure it'll do fine, but the subscriber growth will probably moderate somewhat as well. Sorry, I went back to Disney. But what were you saying,
Oh,
Jack? Sorry.
well, actually, so you mentioned that you were a media trader. I just actually think that that shows your competence and skill as a trader, because as someone who works in the media typically a tough business uh, to be in. But moving on, Tom, let's talk about bonds. The 10-year, as the 10-year has been rising, that's been putting a lot of pressure on these growthy names. Tesla comes to mind. Tesla was down today as the 10-year gapped up about 2 basis points to, I think, 1.66, and Tesla was down about 3-4%. How are you thinking? Will rising bond yields continue to rattle technology stocks? What's your outlook?
My outlook on bonds has been that they are for sale. I've been bearish on bonds. I've thought yields would continue to go up. They reached about 1.75 on the 10-year, which was one of my targets. It's backed off a little bit, and perhaps that's a little bit of maybe there's a little risk off with equities that caused the bonds to rally for a few days. The yields are going to go higher because inflation is going higher, and you have so many different things that are going to be negative for bonds. First of all, you have a lot of people that are crowded into bonds, and a lot of people have never seen a bond market uh, a correction or a crash. I mean, I'm not sure if we're going to get a crash because that would take a rate of change that would be pretty extraordinary. But corporate bonds, the investment grade corporate bonds are down, I think, down 4% year to date. And that's like one of the worst returns for investment grade. You also have like really strong companies like Apple and Google and things with longer duration, solid companies trading, their bonds are trading in the 80s. You have a lot of things that are happening right now. You've got the giant $1.9 trillion stimulus. That's filtering into the world. You've got the reopening that's going to be a natural push for demand. You've got the Fed that continues to on their same path, which they have no seemingly concern for higher yields at this point. And I think they may want to temper the equity markets by allowing yields to go higher, because that will put pressure on the high growth names. So, the thing that kind of makes me nuts is the Fed will take credit for all these jobs that are going to be created, but this is really just people going back to their old jobs as things reopen. So, when I hear a politician or the Fed people say, we're creating jobs, I think they're just they're taking too much credit for themselves, because these are just, it's not like, well, we've got these new, great new jobs for people that are paying more. They're going back to their same old jobs and same careers, and so that's good. Obviously, I'm happy, to see that occurring, but that's going to be inflationary, and we really haven't seen inflation in many decades that could get out of control. And I think the Fed will have to take some step, and whether it's by doing an Operation Twist or trying to keep the short end of the curve, the short end bonds, yields lower. I'm not quite sure what's going to happen, but I do think we're going to see 2% on the 10-year. And even more concerning is the longer duration bonds on the 30-year, because if you have, let's say, 25 base, I'm sort of going off the top of my head. If you have a 25 basis point backup in yields, higher yields, that is like a 4% total return decline on your 30-year bond. And when you're getting, 2%, or if you, for someone that bought a 30-year bond under 1%, it's a terrible return. But if you go up 100 basis points, that's like 21% decline. Now, keep in mind, everybody levers themselves, and we've talked about leverage, and leverage is, great when it's going in your direction, but if it goes in the wrong direction, it could get ugly. The rate of change in yields um, could really surprise some people. So right now we're still pretty, we're cool, everything's fine, but that's a risk, and I'm watching for that risk. And if it happens, it happens. If it doesn't, I still think yields are going to go higher, and it will hurt the growthy names. It will hurt the Russell names that borrow to continue to roll their debt. And the thing is also higher inflation is going to be higher input costs for these companies. So if you have higher material costs um, from whether copper, steel, or any other commodity, those companies are going to have lower margins because they've got to pay more for their product. Now, close to home, my wife is an interior designer, and she's busy as all hell because everybody's moving to Connecticut from New York. And she was telling me the other day, and she's so non-market, complete opposite of me, and you know, and by the way, just so everybody knows, my office, she has two offices here, and I took one office. So as you see behind me, it's designed by Leanne Thornton. But she was telling me that some of her contractors and jobs that are redoing houses, lumber is incredibly hard to get. It's not just expensive, it's hard to get. So I think that's going to be, a situation that other commodities could have that same problem, or it's hard to get. The other thing is energy goes up, crude prices go up, and at $60, I think it's kind of an okay price. It's not going to cause too many concerns. But if that goes up, that's going to be like a tax on the consumer, and that's going to be difficult for airlines. They hedge things, but still, higher cost of crude and fuel will make it difficult for them. And and those stocks are trading you know, like they've never traded this well before. So I think there's a lot of risk out there, and it's probably going to happen maybe 6 months from now, after the reopening and after things start to come back to normal. I mean, remember, coming back to normal, we're going to be back to a place where people are going to be a little bit more sensitive, looking at earnings, looking at valuations, and you may get less stimulus boost. So we'll see. I think going back to normal is going to be a theme for me in what I'm looking at 6 to 9 months, a year from now.
Yeah, that's such a good point. But yeah, that's such a good point, Tom. It's very hard to trade stocks when you are going into an office 9 to 5 or 9 to 6. But going back to what you said earlier about the Fed, the Fed has said that they are really not concerned about rising bond yields. They're not going to do an Operation Twist, as you said, which is, by the way, for people at home, when the Fed sort of switches its purchases to buy more long-term bonds in order to restrict the steepening of the yield curve, and they're not going to do yield curve control, which is a more dramatic way of covering the yield curve control. Tommy, let's say that let's take the Fed at its word, and the 10-year rises above 2%, and the long bonds rise as well. Just paint me a picture of how violent you think it could be for some of these growthy names, which have wobbled quite significantly over the past month or so.
Well, I seriously think that it's just going to be, the best case scenario could be just they go sideways. The worst case scenario is we get something like a 20% correction. Now, that would probably take us back to November, or I don't know. But it certainly would wake some people up, and we'll see if we get there. We could be in for something more. I mean, inflation is a very dangerous thing for the markets, and I just don't think people quite understand the implications of that. I mean, people want inflation; they want to, inflate stuff, and it moves things in the upward direction. And if you're long commodities or certain, assets like that, it's great, but it can also be difficult if you are that contractor looking to buy lumber, and that could be eating into your, what you're making, or builder. I mean, these builders are buying, they're building so much because there's a housing boom. Their input costs are going to go skyrocketing, and it'll be interesting to see if they can pass that along to the consumer.
Tom, I want to. Sorry, I'm hearing a little bit of echo. So, Tom, I want to zoom in a little bit on a particular stock that is the epitome of a growthy stock, of somewhat of a meme stock. It's Tesla. It's retreated from its highs that it was at earlier in the year. I understand you've been eyeing this as a long time, eyeing this stock for a long time as something that is overvalued and could decrease. But at the same time, you've been very cautious because you understand risk management, and you understand that this is a meme stock that people believe in very greatly. What can you tell me about Tesla? What are your views right now?
Okay, so my background is that actually the first time I was on Real Vision, I didn't even know I was going to be on Real Vision. I had never been on camera before. I did an interview with Mark Spiegel, who's the biggest, craziest, and one of the nicest short sellers of Tesla. I mean, he's like a stand-up comedian. But anyway, it is by far the craziest stock I've ever seen in my life. And I am a car enthusiast. I'm also, I also look at valuation. So it's people that love Tesla and are buying Tesla believe in this mission. And I love EVs. I think it's a great thing. I can't wait to get one. But the stock doesn't make any sense from a valuation point of view. And last year, I was short the stock in March, and I did put out a note saying, I'm not covering mine, but if you want to cover it, it's at the 200-day moving average. And I probably should have covered it because it doubled. And my size was not awful that it caused me to, fold up shop, but I basically covered it at 200, and now it's at 600. So I started shorting it at 400, and then they got added to the S&P, and I added some on the S&P, and then the ad, and then I added more. So, and I basically have nearly a 5% position in this, and my average is a little higher than this. I trade options in this thing all the time, and it's a comedy show with those as well. But I think the stock's coming into a bit of a reality check, and nothing motivates sellers more than lower prices. So you're starting to lose some sponsorship from the meme guys that were so excited about it, and it still hasn't hit the the uncle point for a lot of sellers. But I also do think that you have some large people in the long-term holders of the stock. Ron Barron sold some, and you probably have a lot more that'll be interesting to see after this last the reporting, the 13F reporting, which I do on hedge fund telemetry as well. But bottom line is, I think that the stock's been under pressure. It's not hitting new highs. I think it was off 40% recently, and it's now down, I think, about 30% off the highs. And the longer this fails to move in the direction for the bulls, I think that it's going to just cause more strife. Now, there's a couple things happening with Tesla too that I think is important. They were profitable because of the emissions credits that they've been able to get, and it's 100% margin for them, so their earnings look great. But if you take those out, they haven't been profitable. So it's a make or break time for them, because their emissions credits that they've had are going to start to decrease and probably go away this year. And the other thing is, I don't think their demand is that good. And I posted on Twitter a chart the other day of Tesla year over year sales or registrations in Europe versus Volkswagen, Renault, and Hyundai and Kia. And those companies are really ramping up deliveries, and Tesla's actually down year over year. And I think that it's also important to know that the Tesla's it'll be interesting to see in the next week when they report their quarterly delivery number, if this is a difficult thing, because there's also a semiconductor shortage, and that's going to affect all automakers, including Tesla. And so you really can't get around that. And maybe the market will give them a pass on that. But I think that reality's starting to kick in. Now, full self-driving is something, there's a video going around. I can't say the name of it was the BS. I don't know what the person who put it on, but it was basically a video of Elon Musk talking about full self-driving, autonomy, and all these promises that he's made that really haven't come to fruition yet. And now I've driven a Tesla, I've driven with the full self-driving or the autonomy that they have. It's level 2, it's not level 5. And level 5 is full autonomy, and that's where the market is, or people, Tesla that bought this for $10,000, they want that. And they're starting to get antsy. So I was on the Tesla Reddit boards, and serious people are saying, we really want this, and I'm worried, or they were saying they were worried because they feel like Tesla could have a class action suit, or regulators could say, this isn't ready for prime time. You're beta testing this in the open roads, and there's tons of videos of it, not working properly or moving in the wrong lane, and it's just extraordinary. But I was saying that I worry that you're going to see some like tragic accident that's going to finally wake up regulators to say, hey, this is level 2, this is not level 5. They're advertising it as full self-driving. People are paying for it, that it's not there yet. There's no robo-taxis. There's no robo-taxis that are going to happen in 2021, maybe not even for the next couple years. That's my prediction.
Gosh,
Let's see
Tom,
where we are.
There is so much there to unpack, and it is so fascinating. I feel like we could talk about this for hours. But really quick, as we approach to a close, you mentioned hedge fund telemetry, your research service, which I've been using as I was preparing for this interview. I understand that you actually have a special offer for Real Vision members. Can you tell them a little bit about that?
Okay. For the first year, our first year is, well, actually, it's $750 a year for the subscription. If you use the code STONKS, the word, talking meme stocks, STONKS, in the coupon code, you'll get $250 off, and it'll be $500 for the first year. And I will tell you right now, my site is really crappy. I have a whole new programming team rebuilding it. So in May, we're relaunching. I say that because I'm totally honest. I'm embarrassed because of it. So it's going to look great. But it's, the research that I put out every day, a daily note, put out a morning call. We've got lots of other things that were in the works. So I think it's worth it. I'd pay for it.
Yeah.
Because I use it.
Tom,
I use I eat my own food.
You are honest to a fault talking about your website. I actually read your website. I thought it was fine, but I personally can vouch for your research. The quality of your research is incredibly good, and I personally really like your style of looking at fundamentals, at sentiment, at market positioning, but also technicals, but not necessarily being dominated and having one of your one of those factors dominate your thinking. So I really recommend it. And I don't think it's there yet, but as soon as this is over, we will put a link to hedge fund telemetry in the description. Tommy, we got to talk. We're running a little bit over time, but we got to just really quickly talk about Tesla, because you were just on fire a few minutes ago when you were talking about that. Oh my God, there's the self-driving thing. There's the emissions credits. The fact that it wouldn't have been included in the S&P 500 if it didn't have those 4 straight quarters of profits, which it got from the emissions credits. But yeah, tell people a little just about that video, because I saw it today. It really was shocking that Elon Musk has been the world's richest man. He has been promising self-driving since 2015, maybe 2014, and self-driving technology just really isn't there. As you say, it's level 2, and you have people who they think it's level 5. They're sleeping in their cars. They're taking naps. They're going in the back seat while this robot that is supposedly super safe is driving them around. How do you think this ends?
Well, I'll give you the best case scenario is that Elon Musk is a genius and all the promises that he made come to fruition. Uh, that would be, amazing. That would, elevate the entire world. But I don't think it's going to happen, or I don't think it's going to happen within the time frame that he's talked about. I think the ARK new price target is completely ridiculous. So look, I think the worst case scenario is the stock just continues to drift lower and competition is ramping. I think there's going to be better quality companies. There's tons of Tesla problems. You go online and look at Tesla service issues, and it's atrocious. So I think there's going to be a competition, and people are going to rethink. I want an EV, but I don't have to buy a Tesla, so maybe I'll buy the Ford Mach-E. One thing about uh, Ark and Kathy Wood, um, I was telling you this earlier, but their report that they put out just had tons of assumptions and crazy things that valuation for their insurance company that doesn't really exist and crazy stuff. But all their old reports and calling for a $4,000 price target, which I thought was completely insane, and it really is. But she was right. So the way I look at it is, um, she hit a hole in one, but she shanked it off of a tree on a cart path and into the hole. Now, it's a hole in one, and you're going to mark one on your scorecard, but it's the ugliest shot ever. And, God bless her. She's done so well. And I think some of that good stuff that she's been able to accomplish, she's, had her inflows up 10x in the last year. She's used to buying these little liquid names and Teslas and things that just go skyrocketing up, and they've worked. But now you have, like, she was, maneuvering a PT boat, and now she's got an aircraft carrier, and it's a little harder to turn that thing around or really get it accelerating. So I think it's going to be a challenge for her. I'm actually short the ARK fund, and it's working. But I also think that, just like we saw today with the liquidity of one of these big funds out there, she's got a terrible liquidity squeeze that could happen, and that's a risk. If I was long that, that would be the first thing I'd be worried about.
You're talking about the fact that they own stocks in illiquid names, and they've just gotten so big that they now own 10, 20, 25% of those stocks. That's what you're talking about?
Yeah, and I can tell you that I've worked on an institutional hedge fund trading desk, and we used to calculate days to cover on our shorts and days to liquidate. And she's got a real problem with some of those that are more than 10 days to liquidate, if that happens. And the other thing is, when I was at a hedge fund, we didn't get redemptions every day or potential redemptions. So we weren't really at risk of that. But she could just, it's an ETF. Someone could just say, I've had enough, I'm out, and they're gone. As well, even worse is that she publishes all of her positions updated every night. Now, I guess I didn't know this because I learned this, but it's an active ETF. So you have to publish all your positions every night. I mean, that's like the worst case scenario, because if people see that you're selling Tesla, they're going to pounce on it or sell it if they're long with you. And I think that's just, it's just, I mean, I think it's amazing. She's promoted herself and now has 10x in assets, but she runs a risk.
Absolutely. Tommy, this has been absolutely fascinating discussing with you, but we're going to have to leave it there. Thank you so
I
much
know
for
it's
joining
Friday.
me.
Who's here? I feel
Yeah.
like Ferris Bueller. Hey, go home, everyone. What are you doing here? Go home.
Maybe the market closed at 4 p.m. Markets never sleep, but they do take a nap at that 4 p.m. And I think they want to get a little entertainment, a little analysis from one of the best researchers I think who's in the game, and that is you, Tommy. So people at home, if you're watching this on YouTube, please smash that like and subscribe button so we can grow the Daily Briefing channel. That's my request number one. My second request is check out Tom Thornton at Hedge Fund Telemetry. Tom, thanks so much for joining us.
Thanks, Jack.